Let's talk about FICO score for a minute, shall we? You guys hear, what's my credit score? What's my FICO score? Well, the FICO score, by definition, is the middle score for you. In other words, you have three credit reporting agencies. You have Experian, Equifax, and TransUnion. So when we say, what is your FICO score? Well, it could be any one of those bureaus. It's the middle number of those three. It could be on Experian, could be on Equifax. That's the number that is used to give you your interest rate or to qualify the risk of your loan to give you your interest rate. It's really important here to know that that is not the only factor that lenders look at. It's important, but truth be told, there are other factors that can make or break your deal. And the first factor that you have to consider is your debt to income ratio. You can have a good score, but a bad debt to income ratio, you may not get a loan. Debt to income ratio is the total of your monthly debts. Let's say you have a $50 credit card payment here, $100 credit card payment here, $500 car payment. All those that report on your credit report, those are all essentially added up for a total number. We add that number to the proposed mortgage payment. So let's say all those debts that are reporting from the credit cards and all that add up to, say, $500 just for easy math. And let's say you want to get a mortgage for $3,000. $3,000 plus 500, 3,500 is your total debts reporting. It's the first number to determine your debt ratio. We take that number and we divide it by your gross qualifying income, not your net income, your gross qualifying income. And that's important. Income is a whole nother category. And let me explain a little bit about that. Some people think they make a certain amount per hour, or they, hey, every check I get X amount of dollars, or no, last year I made this amount. Here's the kicker. Are you compensated salary? Because that's an easy one. Once we know if you're salaried, that's probably the easy, any lender can figure that out. If you're compensated hourly and your hours will vary, that is called variable income. An underwriter is going to take that income, pass it through a formula, and they are going to give you a number that you may not expect. Variable income per hourly is different. Always have your lender run the numbers ahead of time. What about bonus or commission income? Also important. If you receive bonus income or commission income, hopefully you've been receiving it for at least 2 years. And those numbers also will be passed through a formula and averaged out to give you a number. So if you're hourly, but you get big bonuses, or your commission, that income is something you're going to want to have a lender who knows what they're doing calculated up front. I can't tell you how many deals fall apart because lenders don't look at the income. It gets into underwriting, and the underwriter says, we can't use this bonus. We can't use this commission. What were you thinking? It happens more than you know. How about business income? What if you are a business owner? Well, this is also another category that needs to be looked at very, very closely. Lenders will typically look at 2 years of income taxes for personal and business because they want to see what your true income is. Those numbers pass through a formula and they will determine what your qualifying income is. Now, most times this number is different than people think. I talk to business owners all the time that'll show $1 million on their income or their profit and loss statement. But by the time they strategically get with their accountant, they're showing $180,000 a year because they are writing off the moon. That's an issue. Because if you're expecting to use $1 million in income to qualify for your debt to income ratio, but the numbers come in a lot less, you're in trouble. Luckily, there are loan programs out there that we call in the industry non-QM. These are non-mainstream. I'll give you an example. What if you're a business owner and your tax returns are, as I just described, you write off the sun, the moon, whatever. You write it off. You show not much income, but you make a heck of a lot of money. We have something called a bank statement loan. It's a non-QM loan. And what that is we will look at your past 12 months or 24 months. There's two different options. And we will average your monthly business deposits that show up in that account. Now, why is that nice? Because there are tons of business people who are successful who get large chunk deposits from their business transactions, and they do well. And most business owners that I talk with who are frustrated, when we try to do a bank statement loan with them, it ends up being very favorable because we average up all the deposits in the business for a year, and it ends up solving all their problems of income. So that becomes a good income number. Case in point, Borrower I worked with not long ago, their income was, as I mentioned, it was about 150,000 after all the write-offs and all the deductions. Well, when we did the bank statement program, we did the math on it, and their income was about $24,000 a month that we could use to qualify for them. So that was an easy deal. It was a bank statement loan. Now, a bank statement loan being non-QM, the interest rate's going to be a little bit higher, but to them, it was worth it because now they're getting a house. And the good news is we can now game plan for a refinance when rates come back down. We can always just do a bank statement loan, get you in a house. When rates come down and it makes sense, we can refinance you and we can try to use those tax returns next year or the following year. So income, debt, two things we look at. It's not just your FICO score. We're looking at the debt to income ratio. We're looking at a couple of other things to think about. Number one would be reserves. Underwriters and investors like to see that if things go south, if the market tanks, you've got money in a reserve account. Now, when a lender says months of reserves, let's say 3 months of reserves, that means that whatever that proposed mortgage payment is to be, let's say $3,000, if a lender is requiring that you have 3 months reserves for the loan, you need $9,000 in an account somewhere, and it has to be yours and it has to be documented to be yours. That's it. That's what a reserve is. More reserves can strengthen your file, just like a higher credit score, just like a lower DTI. So those are the big three that lenders are going to look at to approve you. They're going to look at the assets. They're going to look at the reserves. They're going to look at the credit. They're going to look at your down payment. Sometimes a little bit more of a down payment can help you. Lower debt to income ratio can help you. Those are the factors you can control. There are outside factors that we can't control, like property type. Just to give you an example, a condo loan is going to likely have a slightly higher risk threshold than a single family residence. So when we go to qualify you there, a condo interest rate can actually be a little bit higher. So don't be surprised if you're talking to a lender and he or she tells you that if this was a single family residence, your rate would be a little bit better than it is as a condo. And the reason is, and the short answer is, everything boils down to investor risk. Is the property risky? Is your FICO score risky? Is your debt ratio risky? All these factors are added up, put into a cup, boiled, and that's who you are. So lenders look at a lot of different things. You can strengthen your file by strengthening one of these categories. Very, very, very important here. No matter how hard you try or whatever your file looks like, no matter how bad your score is, no matter how little reserves you have, no matter how much little income you make, remember, your loan officer's job is to put your file together as clean as possible. And this is the one thing that your lender can control. Gather the documents and paint the picture in a neat fashion. You'll be surprised that a good loan officer can get an approval, the same exact loan approved easily, versus a bad loan officer who doesn't have the file put together, maybe hide some information. I mean, I know loan officers, and I've worked with loan officers who will sometimes not stack a file properly, keep some information out, unintentionally or intentionally, keep a couple details out of the file. Underwriter discovers this, and the underwriter's ears go up, and suddenly the file's high risk. And you know what? Underwriting is a little bit subjective. So if you try to hide information and sneak it by the underwriter and they catch you, number one, it's illegal. Don't ever do it. But number two, it makes your file look weak. And make sure your loan officer is willing to do everything possible to get your file complete, and tell the story to the underwriter by stacking those documents neatly, providing the information, one touch, throw it in there. That's how we do loans, and underwriters see it. They know we're not hiding anything. We've been doing this 2 decades, and sure enough, we get our approval more times than not, less than 24 hours. Keep that in mind. I hope this helps today. If you have any questions about debt ratio or you're struggling to get qualified, give us a call. We probably have a loan option that'll fit your situation, whether you're short funds to close, whether your FICO score is a little challenged, whether you're, something with your income. I mean, we can talk, we can help figure these things out. Hope this helps. Thank you for joining. Have a great day today.